Whenever we hear the phrase blue chip, in our mind pops up a poker table with tons of chips, people with sunglasses on, and tons of money on stake. Well, that's not the case for companies and stocks. In today's video, we will explore the world of blue chip companies, who they are, why they are named like that, and their advantages and disadvantages. First things first, why are they named blue chip? In poker, there are chips of blue, white, and red color. The blue chips have the highest value. This means that blue chip companies are the ones with the highest value in the stock market. This term was firstly used in 1923 by Oliver Gingold, an employee of Dow Jones, to describe stocks that traded at $200 or more per share. But things have changed since then. In order for a company to be called a blue chip one, there are some standards that need to be met. First of all, the company must be included in the biggest stock market indexes, for example, the Dow Jones, the S&P 500, or the Nasdaq. Secondly, the company's capitalization must be over $10 billion. All in all, blue chip companies are well known, well established, and well capitalized. For example, some of the blue chip companies are American Express, Coca-Cola, Exxon, McDonald's, Visa, and Walt Disney. Names we all know and products and services we have all used. Moving on, it's important to see some of the characteristics of blue chip companies. Investors love blue chip stocks because they are less volatile investments. Well-established companies that have healthy economic balance sheets, high liquidity, low to zero debt, and cash reserves provide safety, and investors love that. Moreover, since they are so popular, blue chip stocks are daily traded in high volumes. This provides more safety to investors that want to sell their positions since there will always be someone to buy their stocks. The cherry on the top of the cake is dividends. Most blue chips have long records of paying stable or rising dividends. There are even two special categories for them, named dividend aristocrats who have been paying dividends for at least 25 years in a row, and dividend kings who have been paying dividends for at least 50 years in a row. Just imagine that Procter & Gamble is paying dividends each year for 66 years in a row. Finally, a blue chip company will have survived financial challenges and difficult market cycles. For example, the recent pandemic, the crisis of 2008, and other events that may have caused a company to go bankrupt. But don't get it wrong. Blue chip companies aren't the sanctuary of investing. They are companies that have way less risk than others. There are blue chip companies that fail to survive crises, like General Motors and the Lehman Brothers. On the other hand, there are some things to consider before investing in a blue chip company. Blue chip companies are expensive to purchase. For example, Warren Buffett's company, Berkshire Hathaway, costs $305. Tesla costs $202. Microsoft costs $250. Lockheed Martin costs $475, and the list goes on. To add on that, these companies have lower returns than companies that are growing. A steady yearly low increase accompanied by a good dividend is what they offer. Take, for example, Coca-Cola, a massive company that low-risk investors love. Back in the days in 1983, a share of Coca-Cola only cost $1.04. In 1984, the price was about $1.16. In 1985, the price was $1.46. Just before the 2008 financial crisis, the stock's price was $31. A year later was at $19.55. In 2011, the stock was back on track at $32. Long story short, today, Coca-Cola stock is about $60. Coca-Cola had a steady price increase during the past 40 years with its ups and downs. But when compared to Tesla, the return on investment is incomparable. Tesla's stock was at $1.28 in 2010, and in just 10 years, it was worth $32. And that's not all. In November of 2021, the stock reached the dazzling number of $407 per share. To make it clear, even for those that aren't that good with numbers, on average, Coca-Cola has had an annual growth of about 8%. Isn't that great? On the other hand, Tesla has had an annual growth of 34%. That's 4.25 times more money that you could have made in 20 years less. So you need to think twice if it's worth it putting so much money in one safe stock that will give a good return in a few years, or you should search for a better option in growth stocks that have a better potential of growing faster. At the end of the day, it's up to your risk appetite to choose your strategy. Tell us in the comments if you prefer to invest safely in blue chip companies or in growth stocks with a higher potential for return. Thank you for watching this video. We would appreciate liking this video, and you can subscribe to our channel to stay informed about the upcoming very interesting videos.